Hello, everyone, and thank you for joining us today. Welcome to the Fund Deep Dive Live, where we'll be discussing two new barrier income ETFs. The Simplify Barrier Income ETF, ticker symbol SBAR, and the Simplify Target 15 Distribution ETF, ticker symbol XV for 15%. Simplify has revolutionized the income-focused structured product landscape by offering innovative structured note exposures via ETFs. SBAR and XV offer a more flexible and streamlined alternative to traditional structured products by eliminating bank credit risk, reducing compliance burdens, ensuring continuous liquidity, and seamlessly rolling expired option contracts into new vintages. We believe these investment strategies will offer investors a powerful way to seek higher monthly income. We're excited to show these two strategies with you today. But before I get too far ahead of myself, I want to point out that today's discussion is for information and educational purposes only. With that in mind, to make this as useful as possible for you, we welcome questions and invite you to submit them through the Q&A function at the bottom of your screen. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Joining me today is Sid Sadie. Sid, would you mind introducing yourself for the audience today?
Hi, Jeff. I'm Siddharth, portfolio manager here at Simplify. I've spent the last 10 plus years researching, structuring, trading, and risk managing cross-asset derivatives across investment banks and hedge funds in terms of pedigree, an engineering background, and more recently, a master's degree from Columbia University in financial engineering.
Great. Thanks, Sid. Thank you for joining us today. Sid, by way of just a little bit of kind of landscape background setting here for investors or advisors that maybe haven't used structured notes, could you give us a little bit of color on why investors would seek using structured products?
Absolutely. So structured notes are essentially principal protected, fully funded instruments that allow the buyer to customize their market exposures and incorporate specific features that help them align with their overall investment objective. So it's more of a customized solutions for clients. Examples of uses would be income generation, contingent downside or upside risk, which can be through barriers. It could be enhanced participation through leverage or gearing. It could be embedded protection and volatility mitigation, and more generally, a combination of the above to sort of tailor the risk-reward profile. Go ahead.
Okay. No, go ahead. Go ahead, Sid.
In terms of the market itself, I think the US structured note markets is pretty deep. For the market size, the average per annum dollar notionals are roughly around $150 to $200 billion. And this can be divided into several broad categories. More specifically, in terms of the investment objective, these can be divided into growth and yield. Growth being a specific return participation, or reducing downside risk, and yield being enhanced income generation or defined outcomes.
Great, thank you, Sid. So in some ways, investors would look to the structured market to take away some uncertainty to get more of a specific outcome, participation,
Absolutely.
protection, or income. Okay. As far as the two strategies that we're going to talk about, I'm going to share some slides here. Give me a moment here. So we're going to talk a little bit about SBAR and XV. One of the features that we're seeking with these two strategies is to seek a higher monthly income from selling a put option, a very put option. Embedded within that particular structure, there's this contingent downside based on a predefined level for XBAR and less predefined for XV. The income gets enhanced through the WRSA feature and callability features. And rather than focus on some sort of calendar year expiration, it's a single ticker symbol with a continuous level of maturity. So we're laddering the individual positions so investors don't have to be reminded of a calendar effect of when they expire. So again, high income, there's a contingency barrier level. We enhance the income through the worst of and callability features. From a traditional barrier product that you would buy from a bank, one of the features that we tried to incorporate into this is continuous liquidity. There's no lockup, there's no breakup fee if you if investors want to liquidate their position. We take care of a lot of the operational burden, so investors can buy ETFs pretty easily without a lot of compliance challenges. I think historically, structured notes can create some operational challenges. There's no bank credit risk because all the money from selling the put option is received at the beginning of the term structure. Fully transparent, lower fees, and taxable through the form of 1099. So this is kind of our objective of bringing these to market. We work very closely with advisors to identify what the pain points were, and we're able to bring these to market. So let's continue on here. So Sid, when you think about the definition of it, what is a generic barrier option? It's a term I hadn't heard of until probably 6 months ago. And so maybe you can help our audience understand what a barrier put option is.
Absolutely. So basically, barriers are a way to get contingent or conditional exposure to the underlying risk. I mean, let's take an example here of a conditional downside barrier, which we can also see on the screen. So the conditional downside barrier that we'll be looking into is let's say a European at the money 70% down and input on S&P. It's a very wordy description, but very simply, it represents an at the money S&P put, which becomes active only if the S&P level at maturity is below a particular barrier level, which in this example is 30%. In all scenarios where S&P at maturity ends above this barrier, the option expires worthless. If the S&P is below this barrier at expiry, the payoff would basically mimic that of a vanilla at the money put. So that's a simple way to think about barrier puts. It's a conditional put, which behaves like an at the money put below the barrier, and in all other scenarios, it expires worthless.
Yeah, thank you, Sid, for looking at that. So if the market's down 20% and you've sold a barrier put option, your participation in that is zero, right? You get the income and you don't participate in the drawdown because it didn't break the barrier, correct?
Correct. At
Okay.
maturity, your participation for a 20% drop in the underlying would be zero. Of course, there will be some mark-to-market gains or losses depending upon the move of the underlying.
Okay. So what's your typical tenure for the term structure of barrier put option? What are you looking at there?
So for our products, we have currently used 12-month expiry or 12-month maturity of these options. So essentially taking a step back and thinking about the tenors, which is one of the tools or one of the levers that we have here, increasing the tenor or basically increasing the expiry of the option would typically result in higher payments, but also increased risk for a fixed barrier. Here, it's 70%. Reducing the expiry would increase the risk-adjusted returns for a fixed barrier here being 70%. So the trade-off there is to maintain a high level of income, but increase the risk-adjusted returns. And a good point there would be around 12 months, which offers a good trade-off, but also is a very liquid point where we can go in and trade the structure with all of our bank counterparties.
Gotcha. And by way of path dependency and risk related to path dependency, Sid, can you explain how we're laddering the individual exposures to reduce the risk of a single barrier break where you have the drawdown of greater than 30%?
Absolutely. So the laddering concept is something which is very simple, very prevalent. We also have it across our other products, for instance, HEQT, which is more for the downside buffer. The idea here is that we want to create an evergreen exposure, a balanced risk profile, essentially, which reduces reinvestment risk. These barrier options essentially can be called off at specific dates, which essentially means that you would be left with some amount of cash. While creating this laddered structure, you are going more in line with the market, and so those cash payments can be invested or reinvestment back into the product easily. So this reduces operational burden for clients who were, let's say, already trading these auto call products, but had to go in and look at, oh, is the product knocked off? Or, hey, I need to wait for accumulation of some cash to be able to go in and meet the minimum investment requirement.
Gotcha. So let's talk a little bit about, a single barrier option and kind of what an outcome might look like for investors. Now, this is, again, it's an example of a generic vanilla downside barrier, a single position, and with a 1-year term structure. So at the beginning of the period, January 1, the market's at a level of 100. If the market's up 16%, the share appreciation on the right-hand side of this chart the left-hand side of the chart shows the monthly income distribution of the product of a generic barrier option. So you have consistent monthly income, and then you have market appreciation. So on the right-hand side of the chart here, we're showing the S&P, or in this case, the reference index is up 16%. The theoretical change in NAV is 0. The distributions from the life of the swap is 10%. So your theoretical total return is 10%. Maybe Sid, walk through if the market's down 28% or if the market's down 33%, what sort of total return would the investors kind of expect given this lineup here?
Absolutely. So here we're taking an example of just one structured product trade where we've entered into the trade and we are seeing the life of the option across various moves and underlying. So at maturity, the table on the right sort of defines how the outcomes would look like. In a move where the underlying drops 28%, your income generation, which is 10%, which would be determined at the beginning of the entry date of this product, would still remain at 10%. But because you're still above the 30% barrier, your theoretical loss would be 0. So essentially, you would be making the full 10% if at maturity the market drops 28%, which is still above the barrier. At 33%, you have breached the barrier and you're essentially below it. In this case, the payoff looks very similar to a vanilla put. Your distributions of plus 10% still remain the same, but in line with the vanilla at the money put, your loss on the optionality would be 33%. So in all, you'd be down 23%. And all of this is through the lens of a European knock-in put at maturity. In terms of mark-to-market, you can have certain mark-to-market losses for both these cases, including minus 33% and minus 28%.
Thank you, Sid. And just a couple points to clarify. There will be mark-to-market of these underlying positions on a daily basis. So
Correct.
In theory, if the market's down, say 10, 15%, you can expect to see these perform similar to that, maybe down a little bit less. But the results that we're showing on the screen are just at expiration of a single position, a 30% downside barrier. So just want to make sure people understand that, the income that you're going to receive from this is very attractive, low double-digit income at 10% in this example. But if you have a difficult market throughout the term structure of the barrier option, there will be unrealized losses in the underlying ETF. And then maybe a question here, Sid. So if somebody's looking to buy a barrier income product, that's probably not the best product if they're looking for capital appreciation, because in theory, based on the diagram here, the most we'll earn will be the income at the beginning of the term structure. You might get a little bit of appreciation with the underlying components of the barrier put option, but not a capital appreciation product, right?
Absolutely. You hit the nail right on the head. I think this is more of an income generation or yield product rather than upside participation. So not specifically for if the scenario that we're trying to account for is a very massive upside rally, then this might not be the most suitable product. But if we believe the market is range bound, below, let's say the coupon barrier, which let's say is 10%, then this could be a good product to have on.
Yeah, thank you, Sid. So the example we showed was a single reference index, right? So the product that we'll get into more specifics and get deeper into the two that we brought to market. How did we enhance the income feature? There seems to be a permanent demand for income for investors. What two features did we add to XV and SBAR to give a higher income level for investors?
Absolutely, Jeff. So SBAR and XV have two added differentiators versus vanilla barriers to enhance the income potential. The first one is a worst off feature on a basket of underlyings. And the second one is a callability feature. And we're going to dig a little bit into this. So XBAR and XV employ a barrier put option with a worst off feature. Selling a worst off deep out of the money barrier put on a diversified set of reference assets can allow for collection of higher premiums for the same notional risk. The worst off feature basically dynamically switches the reference underlying for the barrier option payoff to the worst performing asset since the trade date. This results in higher premiums from the structure because the chances of at least one asset ending up below the barrier increase. The second feature would be the callability feature, more specifically, the auto callability. These can be thought of as upside barriers. If all the underlyings in the basket are above a predetermined upside barrier on these predetermined auto call dates, the structure terminates or gets called off. For the same notional exposure, auto callability can add returns over the long run. By structuring these options with a typical 12-month duration, the strategy seeks to maximize the premium retention and liquidity while providing some contingent downside risk mitigation, which eventually can add attractive income streams for investors in the long term.
Okay, so back to the worst of features. So we're using, swaps to gain the exposure. That's something that's unique to, it's easily done in a swap format. So just so people understand, when you looked at that reference visual before, we talked about breaking the barrier. We're looking at three different indices: S&P, NASDAQ, and Russell 2000. At the end of the term structure, if any one of those breaks the barrier, then you have more contingent downside participation, right?
Correct. Yes.
Okay. Very good. So let's compare and contrast a little bit of the two products, because they are focusing a bit different on certain variables. So SBAR is going to be focusing more on a 30% barrier, whereas XV is going to be focusing more on a specific income target, thus the ticker symbol XV for 15. So maybe, Sid, you could provide a little bit more color of the different terms on the screen here and give us an idea of how you'll be thinking more active management on XV and a bit more systematic on SBAR.
Absolutely. So SBAR and XV, as you mentioned, Jeff, are our attempts to offer a liquid and transparent exposure to worst of auto callables on reference assets, which include the US large cap stocks, the US small cap stocks, and the US growth stocks, which on the screen you can see under underlying worst of indices. The reference assets that we use can be indices and or ETFs that represent those indices. SBAR, again, as previously mentioned, is designed to maintain a specific risk threshold with the barrier level set at 70%. Empirical analysis of just rolling 12-month returns across S&P, NASDAQ, and Russell would essentially tell you that the barrier was breached only 6% of the time since 2000. And these 6% scenarios represent extreme risk-off scenarios like GFC in 2008 and COVID. So in essence, this is trying to maintain a lesser level of risk, which only gets hit in extreme risk-off scenarios. In contrast, XV aims to achieve a 15% income target by strategically adjusting parameters like option tenor, which, and we know here is 12-month, the barrier level, which for SBAR is fixed at 70, but for XV can vary, and callability to hit income goals in a more sustainable way. So XV is more of a dynamic, actively managed approach, which can or is trying to balance risk versus yield. And by design, I mean, SBAR distributions would be lower than XV in typical environments. And XV barrier would essentially vary to try and target that 15% outcome.
Gotcha. So investors that obviously, investing 101, take more risk, you expect a higher return. So if you're looking for, maybe a consistent implementation with a 30% barrier, as long as those three indices do not break the barrier, you get to keep the income. Whereas XV is a bit more actively managed, seeking opportunities as presented by the market. And in an elevated environment we've had here as of late, you probably are seeing higher realized yields based on, the vol surface being elevated given the tariff tantrums, correct?
Absolutely, absolutely. And this allows us to take less risk and still hit that 15% target, which is kind of the basis of our sustainable 15% return target.
Gotcha. Okay, Sid. So if an advisor is looking at these two products to include in their portfolio, obviously there's an income element because they're called barrier income products. So how should an advisor think about incorporating this into a portfolio? Because you're going to have a high level of income, but there's going to be a bit of volatility driven by three equity indices, and so that might create a little bit of volatility throughout the ownership of the particular product. But where would be a good source of funds for investors to allocate to SBAR or XV?
Absolutely. So I think for SBAR and XV, the objective, as you outlined at the very beginning, is to target a higher monthly income. Of course, that higher monthly income can come with higher volatility because we do have some contingent downside risk, and this volatility can be higher than fixed income investments, which typically form part of a equity plus fixed income portfolio. So what we've seen uh, across all our clients and the different conversations that we've been having is one way for clients is to allocate some portion of their equity and fixed income portfolios and allocate them into SBAR and XV ETFs for this alternative income stream. So essentially they can play both sides. In a scenario where the markets are contained between the upside coupon and the downside contingency, these can generate higher returns versus holding the two assets separately. And so this is a diversifying feature for their overall portfolio. That's one way to think about it.
Yeah, that's very helpful. I'm going to switch gears to a couple questions that have come through the chat feature. Again, if you have questions, go ahead and submit them through the Q&A feature. And I'm going to ask Sid the really hard question. So does the monthly distribution continue even if the index breaches the barrier level? So if one of the three indices breaks the barrier, does the income continue, or how does that feature work within the strategy?
So I think this comes back to the laddering and the evergreen product. If one of the underlyings or one of the puts or structured notes that we have in the portfolio hits the barrier, there might be others which are still above that barrier. And so as long as we are realizing the capital appreciation and the coupon, we will continue paying the dividends.
Gotcha. And just again, to clarify, because I don't want people to misunderstand how the product works, it's only at expiration of a particular portion of the portfolio. So for
Correct.
laddering the positions, one of them could break the barrier at expiration, but that would be a percentage of the total portfolio,
Correct.
not the entire portfolio, right?
Correct. Yes.
Okay. Another question, are the puts cash covered, or is there any leverage within the operational nature of XV or SBAR?
So for both SBAR and XV, we are targeting 100% notional, which means that they're fully cash covered.
Okay.
The only levers that we are pulling are across the parameters for the structured note, but not playing with leverage.
Okay, great. Thank you. So when you think about investors that maybe have used, maybe to our more experienced investors on the line that have used structured products, what's the major benefit that we provide with SBAR and XV being in the ETF wrapper? Because I think folks have used structured notes for a very long time. It's one of the oldest ways of gaining exposure to certain outcomes. But what makes our product the most useful for folks in a balanced portfolio?
Sure. And Jeff, you had outlined this, and maybe I'll touch on the few things that we had outlined before. I think there's like 5 key benefits from our lens. The first one is operational ease. For instance, using this ETF eliminates the need to pool capital for like minimum investment targets, source trading partners, set up credit agreements, design booking systems, risk tools, etc. All of those things can be avoided by directly investing in the ETF. Second one is liquidity. Of course, this exposure is offered through liquid ETFs, which have both intraday and end of day liquidity, versus traditional notes, which can have long-term rigid lockup periods or high early redemption fees. both of those sort of constrain you to not go in and out of the trade as needed, or if you needed the cash inside the investment. The third one is systematic rolling and laddering. Again, we've discussed this, but essentially this gives you this evergreen exposure, a balanced risk profile, reduces reinvestment risk, avoids all the complexities of rolling the cash and the exposures, reduces path dependency, enhances cash liquidity. I mean, let me know when to stop. Uh, the fourth one is reduced credit risk. This can be more important. More recently, we've seen certain banks who were big issuers of structured products go under, or being bought for cents on the dollar. The Simplify BAR ETFs basically invest the excess cash in T-bills versus the traditionally offered notes, which embed exposure to credit risk and credit risk of the issuer and issuer solvency. So all of those can be avoided by trading these ETFs. The last one, which is sort of a mix of all of those above, but just important, is it's fully transparent structure, has lower fees, avoids K1 tax forms for investor convenience. All of these features make this cost-effective and streamlined solution for accessing structured note benefits.
Yeah, very, very powerful value proposition here. Sid, thank you for going through those again. I think, again, it's just an innovation that's happening here at Simplify and another tool set for investors to use in their outcome-based solutions. Another question that came in is how is the income tax? So there's going to be treasury income from the T-bills that we own, as well as the income from selling the barrier put option. How is that taxed?
Ordinary income. Could be
Ordinary income.
taxes.
Okay. And then just to remind people, no credit risk, right? Because we're not
Correct.
buying individual securities. We're not at the mercy of the financial statements of a bank. So counterparty risk is non-existent because we have
Lower.
capital.
Yeah.
We have the capital at the front end of the period. We distribute that as time expires. And then any sort of duration risk is going to come with just the treasuries that we hold within the strategy, right?
Correct. Lower duration risk because we are mostly investing in shorter duration T-bills. So it's much lower than other fixed income books around, let's say, for example, right now, 30-year would have been a tough one, while we are almost not impacted by that.
Okay. One question that's come in is walk us through the sensitivity to a changing interest rate environment. So let's say rates eventually normalize and go down. Would we expect the income level to go down? I guess it's a multi-pronged approach. If income goes down, rates go down, and vol goes down, you would probably expect lower income, right? If
Correct.
the other thing happens, you would expect higher income and a mixture of the two, right?
Absolutely. So, I mean, the biggest, the first order exposure is from the T-bills. So if interest rates do go down, we would see a drop in the overall yields, which would be in line with the difference in rates. So for instance, right now, please don't quote me on this, but I think roughly the T-bills that we had bought are 4.3% yield. If tomorrow this goes down to 3, then the overall yield of the portfolio would reduce from, let's say, 10% target right now to 8% or 9%, in line with the decrease in rates. There are second order effects coming from how interest rates impact forwards, how interest rate impacts volatility, and all these other things. But first order still remains consistent.
Okay. Two questions. Two different individuals asked the same question, so I'll ask it here. What sort of, and you probably don't need to mention specific brokers, but who are counterparties on the swaps? Is it a wide range of banks?
Yeah, so we have multiple bulge bracket global banks as counterparties on these products. We have access to them through our ISDAs and CSAs, and of course we do have the in-house expertise to understand and price these products and sort of be more on top of what we are trading and how we are optimizing the RFQ.
Okay. So just by way of maybe holding this position in a portfolio, the mark to market, can you just give not all the Greeks, but just in general, what might influence the mark to market every day? Is it market direction? Is it rates? Give us a sense of what can move a position to an unrealized gain or loss as you hold that position in a portfolio.
Absolutely. I think, again, first order, because of the construction and the way these things are designed, like you do have exposure to market beta. So in scenarios where market is moving up, you are sort of accumulating some of the premium or realizing some of the premium that you had earned from selling that option. And versus on the other side, if market goes down, you would see some mark-to-market losses, which essentially, and this is just first order, it's essentially pinpoint to the fact that your probability of ending up below the barrier has increased because you're closer to the barrier now. So that's all it represents. So that is sort of reflected in the mark-to-market on a daily basis.
Gotcha. Yeah, I think that's really important for people to keep in mind is that, you're buying these for income and the income gets distributed, assuming you don't break the barrier. If you do get close to the barrier, there will be some, unrealized positions as you approach that barrier. But again, this is a continuous liquid product. We certainly don't encourage it, but you could buy it, 1 month, sell it the next month, capture the income. I think folks seeking income and a way to get a diversified source of income within a portfolio context, I think is really the value proposition here is high income driven through taking a little bit of risk when it comes to equity drawdown. So Sid, thank you for your insights and perspectives, and I'll wrap it up here. We're kind of running out of time here, but so for everyone who spent time with us today, thank you. We appreciate your time. And Sid, thank you for sharing your perspectives on structured note market and providing educational insights. And most importantly, digging in a little bit deeper into SBAR and XV for our clients and how to use in your portfolio. All of us here at Simplify are excited about these new addition of these barrier income products, SBAR and XV. As you might be able to tell, Sid and I are super excited about having these in our lineup. If you'd like to learn more information about these two products or any products, feel free to reach out to any of us here at Simplify. We're more than happy to help. Thank you all for joining today. And before I sign off, a heads up that our next Fund Deep Dive Live will occur on Thursday, June 26th. Our colleagues Paisley Nardini and Mike Green will be discussing Simplify's high yield ETF, CDX. Have a wonderful evening and thank you.